Welcome to my Chapter 18 review for the Canadian Securities Course, Volume 2. Today we are going to be talking about mutual funds, specifically the types and the features. So there are various different types of mutual funds. One type is the money market funds. Basically, this is when all the assets are in cash or cash equivalent securities. So this would be like either cash or short-term debt, T-bills, banker's acceptance, corporate paper, all sorts of debt that will mature in less than 1 year. And money market funds, they must maintain a minimum weighting of 95% of all assets in cash equivalents. Now, fixed income funds, they're designed to provide a steady stream of income and safety of principal rather than capital appreciation. So mostly they are things like bonds. Usually they're more long-term bonds or medium-term bonds. So anything that matures longer than 1 year. And the primary source of returns from these bond funds is interest income. So interest income, it is taxed at a higher rate than dividends and capital gains, so that is something to keep in mind when you are using bond funds or fixed income funds. Now, balance funds, they invest in both stocks and bonds to provide a balanced mix of income and capital growth. And they do have a wide range here, so they can have 5 to 90% in equities and 10 to 95% in fixed income. So there is a really wide range there of conservative balanced funds to aggressive balanced funds. Now, equity funds, they must have 90% of their non-cash assets in equity securities. And the main objective here is for long-term capital growth. So basically, these funds have 90% of their assets into the stock market. So they are more risky, they do fluctuate more, but they do have a higher potential for that long-term capital growth. Now, there is also dividend funds, and these provide tax advantage income, which is dividends, with some possibility of capital appreciation. So dividend funds invest in preferred shares as well as high-quality blue-chip common stock. And they are considered riskier than bond funds, but they're also less risky than equity funds since they're mostly investing into those mature, highly popular, high market cap companies. Now, some other specific types of mutual funds include small cap and mid cap equity funds. These funds invest in smaller companies that are considered to have a higher potential for growth than large, well-established companies. But of course, there is also much more volatility. Commodity funds invest in either physical commodities or they gain exposure to commodities through the use of derivatives. Specialty funds, these actually include geographic and sector funds. So a geographic fund could be an emerging market fund, for example, where it invests in a specific area. Emerging market would be more like China, India, those emerging markets, whereas sector funds invest in specific industries. So for example, there would be sector funds for energy, sector funds for technology, and these are much more volatile because for example, if something impacts that specific industry, these funds will fluctuate a lot. Now, target date funds, these are another type of really interesting funds. They're structured on the assumption that risk tolerance declines as the investor grows older. So as you reach closer to that target date that is put on the fund. Now, they do have the target date. It's basically a maturity date. You can think of it like that. And it has a glide path. So this refers to the changes in the fund's asset allocation mix over time. And these funds, they are used for, or they were made for retirement. However, they're excellent for RESPs because that is a definitive time when you will be using the money. So if someone is going to be using RESPs, target date funds are great for that. Now, alternative funds, were introduced in 2019, and they employ strategies such as short selling and leveraging. They may also use speculative and hedging strategies. You also have index funds, and that they set out to match the performance of a broad market index by matching their holdings and weighting, and the MER is typically lower. So these are a lot like ETFs. However, they're mutual fund ETFs. So they are a mutual fund, but they sort of act like ETFs. And this has a bit of a higher MER than regular ETFs, but it does have some flexibility to it. And so comparing these funds in terms of risk versus return, so the lower risk funds that have the lowest returns, these would be liquid funds, so money market funds. The next one would be debt funds or fixed income funds. And then as you get a bit more risky, you go to balanced funds. However, they're still not really that risky. From balanced funds, you move to index funds, from index funds to equity funds, and then finally those sectorial funds, which invest in a specific industry. Now, there is different fund management styles. First off, you have indexing. This is a passive style of investing in securities, and they basically try to replicate the performance of a market benchmark, such as the S&P 500 or TSX Composite Index. And they are typically low-cost, long-term buy and hold strategies. There's also the closet indexing, and this is when it does not replicate the market exactly, but it sticks fairly close to the market weightings. Sometimes this is used for things like bond funds where you can't actually match the index, and you might need to sort of try and replicate it closely, but not exactly. There is also active styles of fund management. This is probably more common. And most equity funds use this, and it may involve individual company selections or overweighting in favored segments. Now, the redemption of mutual fund units or shares does have sort of a process. So basically, to redeem a client's mutual fund units, the client will need to contact you and ask to sell or redeem the fund. You can then place the trade request, and then with mutual funds, at the end of the valuation day, the fund calculates their net asset value per share, and then the proceeds are sent to the investor. So you won't actually know the net asset value per share until the end of the trading day. So that is when you will sort of determine how many shares are sold. Now, there are some tax consequences for redemption. And mutual funds, they can generate taxable income in non-tax or in non-registered accounts. So that would be like a non-registered account. And they generate this taxable income through the distributions of interest income, dividends, and capital gains realized by the fund. So sometimes the mutual fund manager will distribute interest income or dividends or capital gains to the investors. And they will basically get a T5 or T3 showing this income, and you will need to pay it during tax time, and this is only for non-registered accounts. And then you can also generate taxable income by selling the fund, and the capital gains realized on that will be taxable income. And here is sort of an example of distributions. So I'm just going to go through the example here. So basically, if the fund, let's say the fund has 1 million units, okay, and the net asset value per share is 9. So basically that means that the fund is worth $9 million in total net assets. Say they're giving out a dividend or distributions of 0.9. So this would mean that the fund is giving out 0.9 times 1 million units, so $900,000 of cash. Now, a lot like stocks, when a dividend is given out, it actually decreases the price of a stock, and it's the same with mutual funds. So the new net asset value per share will be the 9 subtract the dividend. So 9 minus 0.9. So the new net asset value per share is 8.10. And because of this, you will be issuing new units. So you aren't actually getting that $900,000 in cash as an investor. You're actually given units. So the new units issued will be 111,000 or so. So this will bump up the total units to 1.111 million. And the total net assets actually comes out to equal the 9 million, which is actually the same before the dividend. So that's sort of how the distributions work. It does increase the adjusted cost base. So you are paying the tax on those dividends. for the new units issued, but it will increase your adjusted cost base. Now, there are also a few different withdrawal plans for mutual funds. First off, you have the ratio withdrawal plan, and this is when you withdraw a certain percentage of the mutual fund per year. You also have the fixed dollar withdrawal plan, so basically you're just withdrawing a fixed dollar amount per year. There's also the fixed period withdrawal plan. This is a bit different. So it is a specified percentage withdrawn over a predetermined period. And the intent here is that all capital will be exhausted when the plan ends. You also have the life expectancy adjusted withdrawal plan. This is often used for retirement projections or things like that. So basically, the value of the withdrawal is equal to the value of the portfolio divided by the difference between the life expectancy and the current age. Now, if you are using it for a retirement projection, of course, you will have to estimate some sort of growth there. So that would sort of change this withdrawal a little bit. But it is one way to sort of calculate how much someone should be withdrawing from their investment, especially when looking at retirement. Now, next, there is some different ways to measure mutual fund performance. So first off, you have the time-weighted rate of return. This basically does not account for cash flows, but it will show you the rate of return based on the time. And then daily value method, this will calculate the fund performance daily, but it is quite tedious because you, of course, have to do it daily, and it does make a lot of work. You also have the modified Dietz method, and this weights each cash flow by the length of time held in the portfolio. And finally, we do have some different volatility measures for mutual funds. So first off, you have the standard deviation, and this basically shows you sort of the volatility between it. You can see how much it goes up and down. You can also use the bell curve with standard deviation, so 68% of fluctuations stay within one standard deviation, whereas 95% stay within two. So it is sort of a nice gauge for an investor to see how volatile the mutual fund would be. You also have beta, and beta really shows you how volatile it is compared to the market. So if you have a beta of 1, then the mutual fund basically acts the same as a market. So an ETF or mutual fund of an ETF would try to have a beta right around 1 because it would want it to act the same as the market. Whereas if you have a mutual fund that's more aggressive and you want it to act sort of amplify the returns of the index, then you would want it to have a beta of 2. So let's say it does have a beta of 2 and the stock market increases by 10%. Then your specific mutual fund with that beta of 2 would increase by 20%. Now the downside there is, of course, if it decreases by 10%, then your mutual fund decreases by 20%. And another volatility measure is pretty easy. It's just the number of calendar years it has lost money. So that might be a good way for clients to see how flexible or how volatile this mutual fund is. And showing them those calendar years that it has lost money, it sort of can allow them to kind of visualize it in their own mind and see how comfortable they would be with something like that. You can also measure volatility by the fund's best and worst 12-month period performance, and also the fund's worst annual, quarterly, or monthly losses. Now, there are some pitfalls to avoid when you are judging mutual fund performance. The first one, it is a popular one that a lot of people know, and its past performance is not indicative of future performance. So that's a really important one to know when you are looking at these volatility measures. They are using past results to calculate them. And of course, past performance does not indicate future performance. So do keep that in mind. Even though a stock or a mutual fund has performed a certain way in the past, it might not do that in the future. Now, this is the same thing. Historical performance may be relevant if there was a change in portfolio manager. So that's just another reason to realize that past performance doesn't mean future performance, especially if there's a change in that portfolio manager, since they probably do have a different investing style. And also, average return of peer groups can reflect survivorship bias. So a lot of mutual funds, they do calculate their average return and they compare it to other mutual funds in that category. So mutual funds that invest similar to them. However, this comparison can reflect survivorship bias, which means that mutual funds that have performed well, they have stayed relevant, I guess. They haven't vanished. They haven't been converted into a different mutual fund. So if you are looking at the average return for, let's say, a 10-year time period, and you're comparing it to other mutual funds with that 10-year time period, you have to compare it with mutual funds that also have lasted 10 years. Now, if a mutual fund hasn't performed well, of course, it probably hasn't lasted 10 years. They probably got rid of it because it hasn't been performing well. So when you are comparing those average returns to other mutual funds, do realize that it is reflecting that survivorship bias. Another pitfall to avoid is that you should not consider the type of fund and its investment objectives. And also, along with that, you cannot compare dissimilar funds. So if you are looking at an equity fund, you cannot compare it to a balanced fund or a bond fund. You should only compare an equity fund with another equity fund. Sometimes you would have a client looking at a certain bond fund and they're wondering why it has only earned maybe 3 or 4% compared to their equity fund that has earned 9 or 10%. And that really isn't a fair comparison because you're not comparing apples to apples. It's sort of different because the bond fund, its purpose isn't for that capital appreciation. It isn't for the high returns. It's for the safety. Whereas the equity fund is different. It's supposed to be more volatile and it's supposed to provide that growth rather than the safety. And you should also be aware of selective reporting. So for example, if you are looking at a report that is showing a certain rate of return, they might pick probably maybe even the best period of return. So a great example would be if you're looking at the 1-year return for a mutual fund and you're comparing it to the bottom of the market from 2020. So let's say March of 2020 to March of 2021. That is selective reporting because they are picking the time period where if you invest at the bottom of the market, it would have increased the most from that recovery from the COVID pandemic. So those are just some pitfalls to avoid in judging mutual fund performance. I do think that this chapter is really important and gives you a nice baseline to understanding mutual funds. And so I really hope you found this sort of chapter review helpful. Of course, I am going to be making the next chapter, which is chapter 19 soon, so stay tuned for that.